the most recent amendment of the Act, the 2021 Finance Act, signed into law on December 31, 2021 by the President, addresses 5 key fiscal reform areas. 1, domestic revenue mobilization. 2, tax administration. 3, internal taxation. 4, financial sector reform. And 5, public financial management. It is expected that the 2021 Finance Act will consolidate the achievements of the previous acts in accelerating non-oil revenue generation in Nigeria. This is particularly important considering the need to close the widening fiscal gaps in the face of high fiscal deficits and mounting debt stocks. The Finance Act is one of the direct policy tools with the potential to boost domestic revenue mobilization. However, despite its perceived benefits, the Act poses an important policy dilemma: the under-limited fiscal space, which poses the question: how much tax revenue can governments raise to the extent that tax measures do not have a deleterious impact on households and does not stifle investment and economic growth? Clearly, there are expected trade-offs emanating from the 2021 Finance Act. On one hand, the Act contains tax measures and tax administration changes that can help the federal government raise more non-oil tax revenues and realize fiscal sustainability. But on the other hand, the Act introduces some tax increases that may be burdensome for individuals and businesses. Therefore, unraveling this dilemma will require an evidence-based assessment of the impact of the tax measures as presented in the 2021 Finance Act. And this is in accordance with our tradition of evidence-based advocacy here in the NESG in the national interest. This roundtable will therefore engage relevant stakeholders to assess the likely impact of the 2021 Finance Act on households, firms, subsectors, and the macroeconomy at large. It is our hope that today's public-private dialogue will help to facilitate the involvement of key stakeholders from the public and private sectors to assess the micro and economy-wide impact of the 2021 Finance Act, identify the key bottlenecks to its implementation, and articulate an action plan that can help policymakers in designing subsequent finance acts. I thank you for your kind attention, and we look forward to a fruitful, robust, and progressive deliberation. Thank you very much.
Thank you very much, Mr. Nana Ude, for that, representing the CEO of the Nigerian Economic Summit Group. I think I'll proceed now, and I would like to, 1 second. I'll just share my screen again. Okay. Right. I would like to spend about 10 minutes or thereabouts just setting the context for the conversation today. First, I'd like to start with a high-level overview of the fiscal landscape and the economic challenges that we face. This is to provide context, like I said, because again, without the context, we may be missing the points. So we need to look at the fiscal landscape as covering 3 broad areas. That's public revenue, public debt, and public spending, and they're all connected. So Nigeria's tax base is small, and the system faces structural challenges with the tax system as a whole. Tax net, tax base, who bears the burden of tax, how do you collect taxes? So not only at the federal level, but also sub-national level. The country has little fiscal space to provide incentives which further deteriorated as a result of COVID-19. Why revenue declined, the need to spend increased for very obvious reasons. Our debt is growing faster than our GDP, and our debt service cost is growing much faster than our revenue. And so this trend we need to reverse. As many of you may be aware, the World Bank listed Nigeria as one of the top 10 countries that says IDA. Debt in itself is not a problem. We've said this many times. As a matter of fact, as at the end of 2020, the level of debt globally aggregates was about 355% of global GDP. And this is a combination of public sector, i.e. government, of companies, corporates, as well as households. If we disaggregate, the average globally for government was 105% of GDP. Total amount of debt, $281 trillion. Right, so, but in any case, within our own context, we need to think about policy measures and interventions that are required to stimulate inclusive economic growth so that we can also at the same time create prosperity and improve revenue mobilization to reverse the trend that we're seeing. So where does the Finance Act 2021 comes in? Of course, we know that this is the third in this series. We had Finance Act 2019, we had 2020, and now it's 2021. And it's important to remind people that a lot of incentives were introduced through the Finance Act of 2019 in particular, some more through the 2020 Finance Act. And again, remember we said government has very little fiscal space to continue to give incentives. So these may have informed the reason why we see some new taxes being introduced. And then the question is, are the timings appropriate? Have they been properly designed? Will they be able to deliver on the objectives such that overall the economy is better off as a result of these policies? So the Finance Act 2021 amends 13 different tax and fiscal laws. So it's not only just tax laws. It was signed at the end of 2021. Effective date is 1st of January 2022, except as may be prescribed by the National Assembly or by the President by an order. So this was a special provision in the Finance Act that we didn't have in the previous versions, which means the President can decide either as a whole for the whole Finance Act or any portion thereof to prescribe a future or a different commencement date. So of course, the Finance Act is designed to help support the implementation of the budget, the MTEP, as well as deliver on the strategic revenue growth initiative of the government. The key objectives, Nana mentioned this, include ensuring that we have the appropriate fiscal policy responses to economic challenges. How do we reform extant laws, including those to do with the financial services sector, digital economy, but while still ensuring economic growth and socioeconomic development. Of course, we need to raise revenue for government. So by way of a quick summary, the notable changes introduced by the Finance Act 2021 include, I've put them into about 5 different buckets. Those seeking to introduce new taxes and increases in existing tax rates. For example, tertiary education tax was increased from 2% to 2.5%. So maybe I need to say also that being a member of the committee that supported government in working on this finance bill that became the Finance Act, I can tell you that some of these new taxes were introduced by the National Assembly. It's the same government, but just to put in context. So like the education tax was a decision by the lawmakers to increase from 2% to 2.5%. There's the introduction of capital gains tax on shares exceeding 100 million any 12-month period if you do not reinvest. Excise tax has been introduced on sweetened beverages, 10 naira per liter. There is the engineering, science and engineering levy that has been introduced for certain sectors of the economy. including aviation, telecommunication, banking, and a few others. Then there's police tax, which is applicable to everyone. Then some incentives government is trying to streamline and roll back. For example, the export incentive available when you export products out of Nigeria other than oil has been removed for downstream sector of the Nigerian economy, as well as the new midstream sector. And for life assurance, if you pay life assurance premium, you could get a deduction for everything before. Now the law has restricted that to only the components relating to life assurance, excluding deferred annuity. Educational institutions are now liable to corporate income tax because they have been deleted from the list of exemption, regardless of whether it is, for public or not for public, or whether it's of a public character. Even if you are running this as a not-for-profit organization, to the extent that a fee is charged, then you will have to pay corporate income tax. A few tax breaks. Minimum tax was reduced from 0.5% to 0.25% last year. But what the Finance Act 2021 has done is to provide clarity and expand the period within which the 2 years relief can be enjoyed. And then there was an amendment to clarify that unit trusts, when they do receive income on which withholding tax has been deducted, they will pay no further taxes. So this will benefit people who invest in these schemes, including investment by people who take retirement for their pension scheme. For small businesses, there was a provision to provide for compulsory and deemed utilization of capital allowances by small businesses that are exempt from CIT. The idea is if you are not paying corporate income tax as a small business, you should not have to carry forward your capital allowances on your assets. While this makes sense, it could also mean that small businesses may be worse off if the capital allowance you are deemed to have utilized is worth more than the tax exemption you were granted. And for the police trust fund levy, there is no exemption for small businesses, even though small businesses are exempted from corporate income tax and tertiary education tax, but there's no exemption for the police trust fund levy. So they have to file returns and pay and comply with that provision. Other reforms include non-resident companies, including global digital companies, can now be assessed to corporate income tax as a percentage of their turnover on a fair and reasonable basis. There's a restriction to the capital allowance you can claim. If you earn non-taxable income, it has to be prorated. And the law now further empowers the FRS to use technology for tax administration. I think this is quite positive. Because if you can just get everybody today to pay their fair share of taxes, and we can reduce evasion significantly and reduce aggressive avoidance, our narratives will be quite different. And then the FRS, maybe I'll say just a reminder, because it's already there in various laws, as a primary tax agency of the federal government was also included. So these are the broad changes in context. And I thought it would be good to just bring this back again. The Fiscal Policy Roundtable of the Nigerian Economic Summit Group about 2 years ago, with support from the Bill and Melinda Gates Foundation, conducted a national study on tax morale, or what you call tax perception survey. And at the end of this very robust and comprehensive exercise, the roundtable came up with key recommendations, and we summarize these and we call it the imperative for a sustainable fiscal system, and it's the 10-point agenda. We have 3 recommendations under policies, 3 recommendations under legislation, 3 recommendations under administration, and at the center of it all is the need for governance, transparency, and accountability, because we discovered that the tax morale for Nigerians at the time we conducted the survey and up till now is the lowest that we have seen around the globe, and this needs to change. So that's the quick overview. And now I will have the pleasure to invite the Honorable Minister of Budget, Finance, Budget and National Planning, Dr. Mrs. Zainab Ahmed, to please give us her keynote address. Honorable Minister, you have the virtual floor. Secretariat, can you confirm that we have the Honorable Minister on the call?
She's trying to log in. Please just give us 1 minute, sir. Please.
All right, thank you.
Sorry, we can.
All right, so yes, we can continue while we wait for the Honorable Minister to join in the interest of time. And as soon as the Honorable Minister is able to join, we will then allow her to give a keynote address and as well join the panel. So I have the pleasure to invite for the panel session Engineer Maxwell Ahmed, who is the President, Manufacturers Association of Nigeria, Mr. Alfred Olajide, who is the Vice President and Managing Director for Coca-Cola Nigeria, Dr. Nopo Ebohime, so hopefully I pronounced that well, who is the Head Research Department for the Nigeria Labour Congress, as well as Mr. Temi Pokuola, who is the CEO of the Nigerian Exchange Limited. And I shall be the moderator for this session. So welcome everyone. Please take your virtual seats on our panel. And we're gonna start by going around for our panelists to give their perspectives for about, keep it to about 8 minutes as much as possible, so we can have enough time to go around. After which, I will then ask some questions, and time permitting, we'll then be able to, so I think, is the Honorable Minister here now? And if time permits, we can then take questions from our participants. So let me start in the order in which we have, on the screen that I projected before. If we can have Engineer Ahmed. Sir, please give us your remarks.
Well, thank you very much, Tao. And let me thank the NESG for, I hope you can hear me. Hello?
Yes, we can hear you, sir. Go ahead.
Okay, let me thank the NESG for inviting me to participate in this very important webinar. First of all, I believe we should all welcome the return of fiscal policy to the ecosystem of economic management. There was a time when it felt as if the economy is being run basically through monetary interventions. I think it is important that fiscal policy should take its the rightful place to ensure balance and consistency in economic management, but certainly to ensure that both short-term and long-term considerations are brought into the economic management place. Secondly, it's a very broad area of discussion. So what I'll do, I'll probably pick some of the issues that I believe are particularly important for the manufacturing sector, which I represent through the Manufacturing Association of Nigeria. And to that extent, let me start with the issue of the tax administration. It's always a sort of balance, to try to balance the issues between revenue mobilization and, in fact, the tax burden on taxpayers. We do recognize that under the current circumstances, the government must do something to increase revenue significantly, because the alternative, the not doing so, places a very, very severe strain on the economy, and particularly on operators in the economy. We have said often enough that one of the key things, one of the key approaches that we don't seem to address much, which I think to some extent is being addressed now, is looking at the fiscal space, the revenue, the tax space. Our tax net is not sufficiently broad enough, and we have always suggested that there's need to broaden the tax net to ensure that all those who are paying taxes do pay taxes, all those who are eligible to pay taxes do pay taxes, and pay the correct amount of taxes. And I think this is an area that we must continue to push, particularly the internal revenue agencies across the various tiers of government to be more effective in ensuring that we identify tax obligations on all taxpayers and collect the correct amount of tax. To this extent, the Finance Act 2021 introduces some interesting initiatives. One, of course, is the introduction of technology into the tax management and tax collection system. And I think this should be welcome to the extent that it is also fairly administered, and it should not be allowed to be seen by taxpayers as an imposition and perhaps as an additional source of burden to the operational costs. First, I think it is important that the acceptance of the taxpayers, of the stakeholders, should be sought, that there's need for more sensitization of how this is going to happen, and particularly also to ensure that those who are unable to create the technology space into which the FIRS can indeed link up are either helped to do so in some way, or perhaps exempted until such time as they're able to do so. Otherwise, it will create some very serious stresses on some companies, particularly in the small and medium sector of our employment. The second issue with regards to taxation, of course, we do note that new taxes have been introduced, or existing taxes have been increased. Now, I think it is important, particularly as we have had, that some of the new taxes are introduced through legislation rather than through executive action. I think we need to ensure that we don't perhaps unintentionally continue to increase the tax burden, especially on those who are already paying all the taxes that they should pay. I believe the executive, and particularly the Minister of Finance and National Budget and Planning, ought to more effectively engage the National Assembly when these new taxes are being introduced, or when existing taxes are being widened, such as, for instance, the TET fund taxes, the increase, the NASENI, the Police Trust Fund, and so on. While we can see some justification for it, we believe that we also need to ensure, as I said before, that the tax burden is not unnecessarily increased. Perhaps some level of engagement and discussion with stakeholders before these issues may be necessary. Also, there's, of course, the issue of timing. As we all know, the last 2.5 years have been extremely stressful for all operators in the economy, but particularly for the manufacturing sector. Not only have costs gone up substantially because of issues with the logistics issues in particular, but also with the market contraction that has taken place, but also with the implication of the consequences of the pandemic that we all know. I don't want to go through all this, but for instance, the fact that import of some very critical raw materials have been clearly suppressed in some areas, and I think this should be taken into account. So perhaps with regards to these new taxes, and particularly, for instance, the excise duty that is introduced on some sectors of the economy, I think there is need to look at whether this is the right time to do so. Thirdly, I think the issue of debt, which I think has also been raised, is very critical. And we all know that the government has always used the tax to GDP ratio to justify the fact that we still have space to borrow. But I think when you look at the tax to revenue, and particularly the impact on that on foreign exchange earnings, one must be worried that the continuing increase in our debt, particularly foreign debt, is really closing the foreign exchange space, and that has been and continues to increase significant pressure on availability of foreign exchange, particularly for the manufacturing sector, which we all know has been largely, has depended very, very largely on import of raw materials from abroad and machinery and equipment and spare parts and so on. So I think it's important that we keep an eye on the impact of borrowing that continues to be enhanced. There's some action on export free trade zone, which we think is valid and very important. That the Finance Act has introduced tax exemption on profits of companies operating in the free trade zone on export processing and export processing zones. But I think it is important that the management of these free zones must be tightened, and people who operate in the export trade zones must comply with all the regulations and the requirements, so that we don't have a situation where we create serious issues for operators not operating in the export free trade zone, especially in terms of enabling people operating in the free trade zones to now import their products into the Nigerian market, into the domestic market. I think other issues perhaps that we would want to comment on may have to do, for instance, with the incentive administration. Effort has been made in the new act to perhaps clean up incentive administration. I believe that this is valid, this is useful and welcome. However, again, it is important that the management system, the role particularly of regulators for these incentive systems must really be scaled up in terms of its effectiveness and efficiency, but also in terms of the recognition by such regulators that the purpose of these incentives is to promote growth of the relevant sectors. And I believe that regulators should not continue to see their role as perhaps gatekeepers for these incentives only. I think they should, in fact, be going out to identify operators that actually can benefit from these incentives in a way that benefits the economy generally, and actually ensuring that they understand that. I say this because many of the smaller, and I am always concerned with the small and medium enterprise sector, because they don't have the clout, for instance, to go out and fight for these incentives when necessary. The big companies, okay, they can, but the small companies, I think they need to be assisted to take advantage of these incentives. Not actually, they shouldn't be hampered from using them as and when they have the opportunity to. So overall, I believe that we welcome the new Finance Act, and we hope that this will be sustained. I think it is also appropriate to mention that the introduction of the Finance Act and the effort government is making to ensure that the budget cycle is also aligned with the requirements of the Finance Act also is important. I think this will provide some stability and some consistency in the economic management system. But at the end of the day, I think it must be recognized that the sector, particularly the manufacturing sector, and basically generally the industrial sector, will need to continue to be supported and assisted to strengthen their capacity and to improve their competitiveness, especially in this new regime of the Continental Free Trade Area Agreement. So let me stop here as an overall comment and yield the podium to other speakers. Thank you.
Thank you very much, sir, for that intervention, and thanks for keeping time. Quite a number of very important points. Policy is not just what we say, it's also what we do. We should implement our policies in a way that do not create additional burden, whether it's technology or otherwise, and not to increase the burden on the organizations that are already paying. While we need to also recognize that there have been improvements in engagement, more still needs to be done, and also to consider the timing of reforms to make sure that at the end of the day, it's not counterproductive to the economy, and also to provide a level playing field, especially for people who operate in the free trade zone, and support industrialization, including manufacturing. Very well noted, sir. So thank you very much for those interventions. I'll quickly invite Mr. Temi Popola, the CEO of the Nigerian Exchange Limited, to please share his intervention in not more than 8 minutes.
Thank you very much, Mr. Oyedele, and please permit me to stand on existing protocols. Thank you very much also for having me on here. I think what I would do, I would keep my own remarks very brief. I've been asked really to touch around the capital market impacts of the Finance Act of 2021. Where I would like to start really from, I think just maybe pick it up from where Engineer Ahmed just left off. When we look at this from the capital market lens, it's very understandable and indeed I would say commendable. A lot of the work that's going into the Finance Act, if you take a step back, you would find that this fits into, I guess, the current administration's agenda around this policy. We saw the Petroleum Industry Act, for example, get enacted. This just follows this trend and this theme that certainly is commendable. I think also, as has been said, from a capital market lens, we do understand what the government is trying to do. The government needs to diversify its revenue sources. I think you spoke earlier, or you spoke about what this low tax base is, and this has been very widely spoken about. The ratio of tax receipts in Nigeria, for example, if you look at that across the globe, maybe even across Africa. So those are some of the things, of course, that the Finance Act tries to do, and we do think that this is commendable. Away from that, just looking more specifically now through a capital market lens, I'd like to start also with what I see as potential benefits of this latest amendment. Of course, it builds on gains and benefits that the capital market has witnessed, particularly in 2019. There was a historic benefit for a big part of the capital market, just the REITs, real estate investment trusts. But I think specifically here, one of the things that we see is, for example, there's been a lot more clarity on certain laws and certain parts of the Finance Act that this particular round helped us to clarify. One very good example is around REITs. In the past, if you invested in a real estate investment trust, and I didn't talk much micro level detail just because of the wide format that we have. But there was a lot of potential double taxation that could have happened within REITs. One of the things that this act has done to build in 2019, one was for a recognition of this, what you can call an asset class, and now more recently, just clarifying a little bit more and strengthening, actually, I would say, in the favor of capital markets and eliminating this potential for double taxation. Of course, again, there's several other things that the Act clarifies. This, of course, has the end benefits of just boosting investor confidence. If you look across our markets today, across most of our asset classes, of course, most of the things that drive this is just investor confidence. And we do think that this drives that. But let me speak maybe particularly very quickly to what I would call the direct impacts of this bill to capital markets. Mr. Oyedele, you spoke earlier about this new capital gains tax that has been introduced on any transactions that are over 100 million naira. So in the capital market today, if you did a transaction, it's over 100 million naira. If there's a capital gain on that, you would now be subject to tax. This is new. Historically in our markets, this was exempt from taxes. And so as I spoke earlier, if you looked at this from the lens of what the government is trying to do to diversify revenues, to deepen the tax receipts, this is welcome. But if you look at it from the lens really of capital market depth, capital market growth, and deepening of our capital markets, then I think one would argue that perhaps one could take a second view at this. And really part of the reason is as follows. Today, because of, of course, we're all aware that we're only just recovering. Of course, that recovery is being driven by a lot of the efforts by the government, but the capital markets is no different. We're just recovering. And one of the things that you find is that today, a lot of the drive of this recovery is really by retail investors. If you look, for example, last year, we had a very big offering in December in the capital markets. And when you look at the breakdown of the investors there, it was very, very primarily retail. a lot of the foreign institutional investors have stayed away from our markets. And many of the local institutional investors also have stayed away from our market. So it's really retail investors that are driving our recovery. So when you situate a policy like 100 million naira, now most of the retail investors that we have do not fall 100 million naira. So that's a good thing, one would argue. But what a policy like this does is just it produces some level of uncertainty to investors. And for these retail investors who may have an array of other things to do, this level of uncertainty where they don't have the wherewithal to seek tax advice, to monitor how they get to 100 million naira, things like that, could have a sort of incentive or disincentive for these investors to invest in the market. So that's what potentially you can do to one part of our market, which, as I said, is driving this recovery. Then, of course, you have the institutional investors, mainly local, who also were trying to attract back to the market. When they hear policies like this, there is a potential also that they also then stay away from the market. So you have this potential to, some would argue, stifle what is the current investors and include a few other investors. The second direct potential implication of this also is that today, if you're an investor in federal government securities, so for example, you buy federal government bonds, those are not subject to CGT, to capital gains taxes. And what this also could do is to, without intentionally doing that, force flows into that asset class so that people go in seek of returns because of this capital gains sort of avoidance. And what that could do is, potentially long-term, not so positive effect, where you force the hands of asset managers into an asset class that short-term may look like the right thing to do, but longer-term may not be right for the ultimate beneficiaries. Also, if you think about corporates who also need to raise money for their own efficient capital structure, if you have a situation where funds are just not available for equities as an asset class because of some of these constraints, we might end up in a situation where, again, longer term, we actually then do stifle the opportunity for these corporates to raise money. The second thing that I thought I would mention from a more micro level as far as the impact of this to the capital markets, before I then speak about some not so direct applications, is around securities lending. And again, I'm a little bit worried not to go into specific micro level detail, but one of the things that we still would need some clarity around, as an industry, is the actual treatment of, interest payable and cash flows that relate from securities lending. To be fair, the Finance Act has done quite some work in addressing many of these, but for example, today in a securities lending transaction, it may involve parties, both borrowers and lenders, who are not Nigeria registered corporates. But then part of the Act and part of our legislation also says that a lot of these transactions are under the purview of the SEC, they're under the purview of the Finance Act. Where do you really draw the line? There's still need for a little bit more clarity there as far as the bill is concerned. I think in conclusion, what I'll then speak to is the indirect impact also of the Finance Act on the capital markets. And I think, Mr. Oyedele, when you spoke, you touched on two of them. One, for example, now we're introducing, or the bill is introducing, excise taxes on non-alcoholic beverages. And of course, it's not very difficult to see that investors who come to capital markets come because they expect dividends, they expect that corporates can make money and can ultimately drive returns for them. So I think indirectly, you look at even things like the education tax now that's been introduced, and I think Engineer Ahmed spoke to this. So if you just wear the lens from a more sort of macro standpoint, situating this within the recovery that we're having, there are arguments that could be made as to whether corporates really can handle this and the timing and things like that, such that ultimately what could happen is a not so positive effect on the cash flows of companies, the ability to pay dividends, which then has ultimate impact on capital market investors. So in concluding, I think what I would say is that as a capital market, this certainly is steps in the right direction. Anything that just tries to uphold legislation, uphold policy. The capital market has seen historically very direct positive benefits of the Finance Act. 2021 builds on this, but particularly in some of these areas that I've mentioned, perhaps we could have another opportunity to look at them and to amend them in a longer term sort of positive angle. Thank you very much.
Thank you very much, Mr. Popola, for that. Overall, we have seen positive impact, especially with the previous Finance Act. And you mentioned real estate investment trust scheme, you mentioned regulated security lending, as well as other reforms that have supported the capital market. But then we have some new changes that may be having impacts that may be not unintended, maybe not intended, I should say. Particularly those that impair the ability of the private sector to raise capital. And I have to say that there was something in the press yesterday about the increase in credit to government in January compared to December has increased by 16%. And it seems to be a pure, a trade-off rather, versus lending to the private sector because it's just now more attractive relatively to give to government than it is to finance the private sector. And I'm sure these are areas where we can have further conversation to see whatever modifications we need to make to those policies, again, in the overall interest of the economy. I do understand that the Honorable Minister is on the call but not able to speak. We don't know what's wrong with the technology, so we'll continue. I'm going to invite Dr. Onoho, who is representing the President of the Nigeria Labour Congress, Comrade Ayuba Waba, MNI. Please, you have the podium for your intervention. Please keep it to 7 or 8 minutes.
All right. Thank you, Mr. Oyedele. Thank you so much. I want to issue 2 caveats before I make this contribution that I necessarily have to present on behalf of the Nigeria Labour Congress. The first one is that when we engage the issues that you have raised, we are going to try as much as possible to focus on government policies in relation to, because you seem to have pigeonholed us into discussing the so-called fuel subsidy. But if we have enough time, maybe we can return to the broad conceptual challenges in the Finance Act 2021. But let's face the argument about fuel subsidy. So what I'm saying is that when, I think many of you are familiar with that, I'm essentially an academic. When we teach political science, law, sociology, any of those social science and human legal courses to students, we try to make clarification for them that the government is an agent of the state and that people in government, whether they are elected or appointed, are not the government. They are officials of government. So when I address government this time, I hope I don't want to hurt anybody's sensibility. I want to be clear in my mind that nobody is going to take on undue offense. The second caveat I want to issue is that I noticed that there are over 160 people connected in this program. In other words, there may be some people here who have no fundamental economic training in economics. So I will try to demystify the concepts that apply here so that it will be accessible to anybody. Now, because you want us to talk first about fuel subsidy, I want to say that the Nigeria Labour Congress has a patriotic, very principled position in relation to these debates about fuel subsidy. Fuel subsidy, in the case of fuel subsidy, what is actually an issue is the PMS, petrol premium motor spirit, the one we call petrol. We also all call it fuel anyway. Other ones are also fuel. Now, Congress has been consistently engaged in this process for the last 30 years or more. Sometimes we are beginning to sound like a broken calabash. We say the same thing over and over again, and nobody seems to be listening. So maybe we will try to do this. And perhaps it is an opportunity to say that we have also engaged these things scientifically. For the last, as far as I can remember, we published reports on the fuel subsidy. Actually, we published one this year which we call, I hope you can see that. We published one this year on this debate about fuel subsidy. For the purpose of clarification, let me say categorically that what our government propagates as fuel subsidy does not fit into the logic, the theory, or the practice of subsidy. That is not what government propagates. The subsidy element in it, government does not discuss about. We will discuss that later. I sent 2 tables to your team. I hope they will be able to project them when we get to that stage. The first one is that subsidy in macroeconomic theory is provided to firms, if you like, companies, to help reduce production costs, which can then be passed on to lower prices in order to encourage consumption. That's subsidy. Therefore, we justify subsidy as a solution to the problem of market failures in the production, or if you don't mind, subsidized merit goods, goods that are consumed by a broader public, and public goods, or called alienable or inalienable public goods. Now, what obtains in our country about this PMS debate are oligopolistic practices by agencies of the government of our country. So we can say, and I can say this from the onset, so long as our country depends on imported PMS, diesel, AGO, bitumen, and so on and so forth, so far we will be discussing about subsidy. It will never go away. That argument about subsidy will never go away, so long as we continue to import. Now, I can take this argument further by saying that the unedited slide of the Naira vis-a-vis other foreign currencies entails that whenever we import petroleum products, we'll be subject to the instability and the volatility, not only of the foreign exchange market, but also the terms of trade that we enter into by these subsidies. So our exporting crude oil and importing refined products fulfills all the political economy arguments about gearing towards export orientation of the natural resources of developed countries, of developing countries, and importing the processed goods from the natural resources we export. This is what we call underdevelopment. Underdevelopment is when you don't put your resources to optimal use. Now, let's take these arguments a little bit further. I hope you don't mind if they can project that table now. I will just demonstrate to you that the petroleum product consumed in Nigeria is imported largely from Northwest Europe. Northwest Europe. When it's imported into our country, there are first 3 stages you go through: the free on board cost, which they consider buying it at the refinery gate and all of that. The next one is the cost. In addition to insurance of the vessel itself that is bringing the product, insurance of the goods in transit, and of course, the freight charges, cost, insurance, and freight. Those 3 items I've mentioned, and I will come to them later, are about 74% of the build-up retail prices of PMS in our country. These data I've given to you are from government, because government sort of become a team with labor, and they produce data by themselves that they spend over 74% on cost, insurance, and freight of imported PMS. So what we have in our hands is that when that tanker that brings the PMS comes into Nigeria, it doesn't dock in our ports. It stays in the high seas. Smaller vessels called barges are hired to go and offload the products and take them to tank farms or storage facilities. That's what they call literary charges in number 3 there. That's what they do. And we pay them for those barges, for those literary charges. Depends on the applicable Naira and for the US dollar exchange rates. We pay for that. Then, of course, excuse me, we pay the tank farm owners, the storage facility owners. And then, of course, we pay the Nigerian Ports Authority. We pay NIMASA, because you use Nigerian Ports Authority facilities, and NIMASA is supposed to guarantee the safety of our maritime environment and all of that. We pay what used to be called PPPR or DPR, is now called Nigeria Midstream and Downstream Petroleum Regulatory Authority. We pay them for market regulation. We pay NNPC for the cost of finance, because imported products, we have to pay NNPC. That's what in economics we call it opportunity cost model. What you have done is that, NNPC could have spent the money on some other purpose, but because we imported petroleum product, we have to pay NNPC for that. Before the products are imported into Nigeria, any interested firm, any oil trader has to register with the Nigerian Ministry of Finance, the trade division of Nigerian Ministry of Finance. And when it goes to register, the trade division of Nigerian Ministry of Finance will ask the importer, are you registered with the DPR or NMDPRA, if you don't mind? Do you have a Form M approved by the First Bank, the Central Bank of Nigeria? What is your evidence that where's your invoice from the source of supply? We do all that. All those are costs that are passed over to the consumers. Now, if we take these few things I've said together, you ask yourself, where is subsidy there? These things that government has accused as subsidy. If you imported over 10, you will do the same thing. But there are some items you will pay for. NNPC will not go there and charge you. DPR will not go there and charge you, and so on and so forth. So when our government discusses subsidy, what they are talking about is the landing cost of PMS. And I've told you this landing cost is not just the cost of the products, insurance and freight, but also includes local levies. It includes taxes. It includes administrative costs. That's the landing cost. When they talk about subsidy, that's what they talk about. If it is subsidy, and we have said this over and again, it means the Nigerian government, the Nigerian people are subsidizing foreign countries. We are subsidizing foreign businesses. Because the refineries in Northwest Europe, basically Belgium, Netherlands, that's where they bring the products anyway. The refineries there can afford to hire more labor. They can afford to go to their local banks and ask for working capital. As a matter of fact, at the end of the day, they pay taxes to their government. The workers in the refinery pay taxes, income tax to their local, to their tax jurisdictions. If we are subsidizing foreign economies. We are subsidizing foreign nationals. We are subsidizing foreign businesses. So that is not subsidy. Now,
yeah, please, if you can wrap up in like 1 minute. You've already exceeded time.
You want me to wrap up? Okay. Unfortunately, I guess this debate is not so popular with you. Okay, let's take the second table. Maybe that will make it easier for you. The second table here, I've given you is what they call distribution costs of PMS. This is where the subsidy is. And all of this, you take it together, it comes about 19 naira per liter. What does it mean? We pay transporters allowance for the transportation of products. PF there means Petroleum Collaboration Fund. That has been collapsed now into the NNPPRA. We pay retailers margin. We pay bridging fund. Bridging fund means that the price of PMS in Abuja should be the same in Warri, should be the same in Lagos. That's what bridging fund does for you. And then we'll pay marine transporters average. These elements enable us to reduce the cost of production. These are subsidies. I will consider to you, I'm talking to you as a professional. I'll consider to you that they are subsidies. But why are they there? It's because until 1975 in our country, we had multiple prices of PMS, or petroleum products in our country. In Abuja, you will have 3, Total, Mobil, Ajib, all of them, selling at different prices. So we agreed in this country that we would uniformize the price of petroleum products all over the country. That's why we created all these incentives that you have seen. If anybody wants to remove them, and that's what they want to remove, the 19 naira per liter Fine, let's understand the implication. One fundamental implication is that the cost of production will go up. And I'll give you a very simple example. There's a company in Kano that produces aerosol. There's another company in Lagos. What I'm telling you are facts. I don't want to mention the names, but they are facts. Producing aerosol, insecticides, and all of that. If you remove these subsidy elements, the one in Kano will not be able to compete with the one in Lagos. The one in Lagos who produces products can transport to Kano, it will outcompete the one in Kano. And we have a major challenge in our country. That challenge is uneven the industrialization of our country. If that's what the government wants to do, they should be honest enough to come forward and say it. Labour has a very simple argument, and we have said that over and again. Let us refine our products locally. And there are so many byproducts we can use. I'll give you another example. When the Warri refinery was constructed, it was constructed as a Warri refinery and petrochemical company. Kaduna refinery and petrochemical company. Because we are exporting our crude, the petrochemical sector is dead in those refineries. Nobody's doing them. Then one final thing I want to say here, because when we talk about refinery, people say, oh, it's impossible to do this. I want to tell our colleagues, Nigeria has experience in the construction, operation, and management of refineries. And I'll give an example with our current president. When Muhammadu Buhari was recalled from the Northeast as military governor to Lagos to become Minister of Petroleum Resources, he signed 2 agreements in 1977 to construct the Warri refinery and to construct the Kaduna refinery. The Warri refinery was delivered in middle of 1979 before he left government. He was there at the commissioning. Kaduna refinery was delivered a little bit later because of the Nigerian peculiarity. We went there and started modifying the design and so on and so forth. So nobody can tell us, oh, it's impossible to construct a refinery in 2 years. We cannot do it in 3. We have done it before. What has changed? Our capacity are lower now, or our vision is lower, or our government thinks differently. Now, let me conclude with this. I just want to conclude with this. We, as a Labour Congress, are agreeable. We have committed ourselves to that, to the privatization of the refineries. But we gave only one condition. And that one condition is this. Let us apply a model of privatization that has worked for our country. And it's good that NESG is running this. Late Chief Ernest Shonekan, and many people don't acknowledge what he has done for our country. Late Chief Ernest Shonekan was head of interim government for 3 months, maximum 3 months. I was in government then anyway. Maximum 3 months. And in 3 months, he sorted out the problem in the Nigerian liquefied natural gas. What did he do? He ceded Nigerian state interest in the NESG to the private sector, international oil corporations. They have 51%, and Nigerian government had 49%. And since then, NESG has functioned well. We said, let's try that model in refineries. Government drags its feet. Government is unwilling to do that. And if you don't have a domestic refining capacity, the consequences of fluctuations in the oil market, in the foreign exchange, volatility, and all of that, will continue to impact on the supply of petroleum products of our economy. And that's not what countries do. Countries leverage their internal resources for endogenous growth. They don't take their internal resources and fritter it away and hope to develop. People don't develop that way. That's the argument of Labour Congress. And I hope if we have opportunity, we can talk about the other parts of the finance side. I thank you very much.
All right, thank you very much, Doctor. Actually, so you spent 16 minutes, so which is twice as much. I wasn't trying to cut you off. You actually spend a lot more time, but we allow you to continue because it's a very important point that you're trying to make. I personally like the idea of, can we just privatize? If you allow private sector to have majority interest, but I think it has to also go with the fact that we allow the free market to work. Otherwise, you struggle to find private sector to invest if they are not sure they can recover them. But I'm very glad to hear that, you know, the Labour Congress is thinking about how can we move forward together. It's not just like we are fixated on there has to be subsidy, because at the end of the day, it's about what is good for our country. So thank you very much for those contributions. I'll quickly invite Mr. Alfred Olajide, who is the Vice President and Managing Director of Coca-Cola Nigeria, for his remarks.
Yeah, thank you, Taiwo. Allow me to stand on existing protocol as well. I want to thank NESG for providing this opportunity. I think, Taiwo, you've clearly set the stage on what the Finance Act is geared towards, which essentially is in the context of enabling the government to generate more revenue and fuel the medium-term growth, obviously consolidating on the economic recovery that we were currently seeing from COVID. If you look at the National Development Plan, we actually do see a positive and robust growth trajectory, which is projected to be driven by manufacturing from a growth standpoint. The implication of this is that the preconditions for accelerating the growth in the sector needs to be put in place, essentially encouraging private sector to take long positions in the country, because this is what would be critical to actually bringing this ambition to life. And maybe linking to your previous point on how the excise tax ended up being in the Finance Act, I believe that all the arms of the government, they have a key coordinating role to play in ensuring that the implementation of this plan drives the right investment climate that will attract foreign private investors as well, to continue to put more in the markets with what we have today, where businesses have to cope with a myriad of challenges, from unabating costs, input cost escalation, security, lack of access to required forex, as Engineer Manso already touched on. We appreciate the government's need to drive local non-revenues, but there is a need to really consider the economic impact of the tax increases in view of the ailing industry, particularly for sectors like the food and beverage, and by extension, overall manufacturing landscape. I think the key questions here would be, what are the government arms doing to help the industry at these very challenging times where the costs are skyrocketing, as against introducing new taxes and increasing the burden for the compliant few? How will these taxes, help the industry to grow, create jobs, attract FDIs, which we critically need? A number of years back, Nigeria was the prime destination for foreign direct investment. Today, the story is the flip. It's the other way around. How do we grow our GDP at this time where Nigeria is losing investment to other locations in Africa? So, today, most businesses are in survival mode. So additional taxes like this excise tax, for example, would end up being passed on to the consumers. And of course, the implication here is that, coupled with the double-digit inflation that the consumer is going through, the shrinking purchasing power, of course, will culminate into a reduction in industry performance and all that. And these are all the points that the industry has continued to put on the table, even before the tax was passed to law. Maybe just to kind of put some additional context to it. The excise tax in itself, being a production tax, even makes it worse, which means that it's not based on what is sold, it's based on what is produced. So whether you sell or not, you have to pay, you have returns from trade, you are sampling consumers, it has to be paid. So again, it's a lot of burden at this very critical time. And if you look at the sector, food and beverage specifically, it's so important to the economy that it needs to be protected. It generates about 1.5 million jobs, been paying in excess of 100 billion naira in import duties in the last 3 years. And if it's encouraged to continue to grow, investments will come in, import duty remittances will grow up, and net it becomes a bigger pot of revenue for the government, as against the singular focus on getting more and more from an already struggling industry. So, at this point that the tax has become law, I believe that what the industry is looking forward to is how to better partner with the government, to have a win-win execution of the administration of that drives inclusive outcome, in line with the government's sectoral growth ambition, which we believe is very critical to the country's medium-term growth agenda. So I think, just to summarize, I'm sure we'll have more time to get into details, right? I think, yes, the intent is very clear, but it has to be put in the context of how do we make sure that we don't kill the golden goose that lays the golden egg? Because that's what it is right now, with all the increase in cost and all the struggles for the industry. Is it the right time? Is it the right methodology? And these are all the points that continue to point out to the fact that there indeed needs some more thoughtfulness, collaboration, and partnership as we go forward now that the tax has become law. So that would be by way of introduction from my side. Thank you.
Thank you. Thank you very much, Mr. Olajide. Very well said. I think the fact that your point is we cannot stop supporting the industry, especially at this time when the industry is recovering. And we have to do that in a way that if we support the industry to recover and grow, then the industry is quite supportive, and they have been for a very long time, very supportive of government revenue drive. And your point is also, in my view, quite valid about the fact that the excise seems to be targeting production rather than even the sugar consumption itself, because I can just go and buy sugar now in the market and not have to pay the excise. But again, this point, I'm sure that will serve as input into what the policymakers will take into account in doing a review, and again for future policy amendments and considerations. So thank you very much for that intervention. I think I'll just ask a few questions, maybe one question each. Let me start with Engineer Ahmed. We know that the manufacturing sector plays a critical role, especially because we have high unemployment rates in Nigeria. And we do know that this is one sector that is labor intensive, which means the more the manufacturing sector grows, the more the multiplier effect on employment generation, which then addresses almost all the other challenges we face, including restiveness. But then on one hand, government struggles to provide incentives. So the question is, what do you think, given that government has this limited fiscal space, what can government do to support the manufacturers without breaking the bank from your perspective?
Thank you very much. Well, I think this is what I had already said, that we need to always balance between the options. There's no one straightforward answer. We balance. First, we balance short-term against long-term need. Can you hear me?
Yes,
can you hear me?
Okay,
yes. So I said, again, this is a continuing process of balancing options. First, we have to balance short-term versus long-term issues. You want to raise more taxes, you want to raise more revenue in the short term, but you want to grow the industry in the long term, particularly for the reasons that you have said, that we cannot afford not to continue to increase the potential for job creation that the manufacturing sector offers, especially in our current situation. So I think the issue then is engagement with the sector, engagement with the representatives of the sector, and continuing review of the impact of policies that are indeed being introduced is absolutely essential. I have always said that when, for instance, you conceive a policy that you think is good for the industry and is good for the economy, what you need to do is to engage the sector that will be immediately affected. For instance, with regards to the excise duty on non-alcoholic drinks, there is no justification why you cannot engage the representative of that sector to say, look, we need to increase revenue, and we believe that we can get more revenue by increasing that. But then we know that currently that sector is struggling, and an additional burden will obviously be a problem for the sector, not only because not all of it can be passed. In fact, it can't be passed to the consumer at this stage because the consumer is already overburdened, the market is already very narrow, and so on and so forth. So clearly, you could sit with the sector and with their representative to say, okay, what do we do? Perhaps it's an issue of timing. Perhaps it will be an issue of balancing whatever revenue you're getting from the introduction of other incentives that, as indeed the last speaker said, that can support and assist the sector to be able to cope with the new body, if indeed it is agreed that the new excise deck is necessary and is necessary now. So that's one issue. The second issue is that we have said before that when you are looking for additional revenue, the one obvious sector is there are lots of Nigerians, both corporate entities as well as individuals that are not within tax net, and that should be. And frankly, I think we have not seen sufficient effort to capture these these people outside the tax net. And I think there should be significant effort to be able to do, important, urgent effort to be able to do that. And also to be able to ensure that those who are paying are also paying the right amount of taxes as per the current regulation. So engagement, I think, is the first thing. We must continue to engage, to consult, to work with the private sector, because at the end of the day, whatever policies the government puts in place, the success of that policies and implementation depends on the response and attitude of those who are affected. Secondly, I think we must also continue to pay attention to the longer term, that we want to invite more industries, we want to invite more investment. And investors, yes, investors, they look at what the current offers are in terms of incentives, in terms of, but more importantly, they look at existing operators in the economy and see how well they are doing. If they feel the existing operators are complaining of those things, they are more likely to say, well, okay, if the system is not helping those that are already there, to what extent will they help me? The last issue I want to raise is to recognize that indeed the quickest way to grow any sector, the quickest way to grow an economy is to grow it through the expansion of existing capacity. And therefore, we should place more effort on boosting existing capacity, on helping current operators to boost existing capacity, perhaps then inviting new people to come for greenfield. Because to a large extent, if you enable an existing operator to boost capacity, then that capacity comes on stream much more quickly. That there are a lot of teething problems that has already resolved that will affect new investors. And lastly, increasing employment becomes immediate and becomes much easier because there's already an existing system that new employees will fit into. Thank you.
Thank you very much, sir, for that. I think it's quite clear, and I do agree again, because government does not need to break the bank to provide the enabling environment that would in particular support existing investors, and they then become the, in quotes, testimonies, or even when you want to bring in new investors, including foreign investors. Yes. And also to just improve the level of engagement with players that will be directly impacted when we are trying to introduce new policies, and just to get their perspective, their buy-in, and their support, so we can agree the modalities, the timing, the rates, and every other thing. I think this government is already doing that. We just want to encourage that we do more of that.
To do more.
And do it consistently, yes, and do it consistently. And I like the point also about, can we bring other people into the tax net? Because we have far too few people within the tax net, including, when I say people now, I mean also corporate taxpayers. And even some that are in the tax net are there with just one leg. If we get everyone to pay their fair share, that also provides a level playing field. So which means, as of today, by not dealing with evasion very intentionally, we make it more difficult for honest people to compete. It means that people who are not honest and not paying taxes and playing games are better off economically, and therefore it's not good for the system. So thank you very much for those comments. I would like to go on now and ask Dr. Onoho a question around the subsidy. I see you're very passionate about this, and I like the analysis that you provided. But even if we admit that 74%, like you said, is cost, insurance, and freight, it means that even that 74% is still more than what we are paying today as pump price of petrol, which means to some extent, even by your analysis, we still have significant amounts of subsidy, and which is the reason why government is having to budget a significant amount for subsidy, which unfortunately, whatever that amount was at the time we're having that conversation, has now gone up as a result of what's happening to Russia and Ukraine, affecting the price of energy globally. The question I have for you is, the government in the Finance Act 2019 and 2020 introduced tax exemption for minimum wage. They also increased the list of items that are exempted from VAT to cover basic food item and almost everything that the average Nigerian will have to consume that is not luxury. So, whereas we have seen that over the past few months, NNPC in many months have not been able to remit anything to the Federation account as a result of this subsidy, thereby making it difficult for government at all levels to provide other important social services, including some states haven't been able to pay minimum wage. So the question is, do you think that this payoff is worthwhile even for labor? If we continue to spend so much on subsidy while everything else, including ability to pay workers, is significantly compromised? Your response, please.
Well, thank you, Kayode. No, Taiwo, sorry. I saw a question by one Kayode earlier who says that what we said was misleading, and that's said misinformation. Well, I give my bona fides. I'm an academic. We have absolute fidelity to facts. We can analyze the facts using all kinds of methodology, but the facts, we hold them secret. So maybe I should clarify that one so that we can answer your questions. On the 14th of December 2020, the government of Nigeria set up a committee that includes, I'll give you the name, Engineer Onoche Azubuike Anyanku, chairman from government, Umar Ajia, alternate chairman, NNPC, Ahmed Boboy, Petroleum Equalization Fund, Victor Shidok, Petroleum Product Pricing Regulatory Agency, Ahmed Zakari, special advisor to the president on infrastructure. We had 2 members. NSC had 2 members. Another people had Trade Union had 2 members. Pegasa had 1 member. Tank had 1 member. The secretary was Lawa Musa, NNPC. I have that information. We have published it. I'm not hiding it. We have published it. That's the list. We have published it so that we don't do this thing behind the scene and people think that we do not know what we're talking about. And page 11 said gasoline cost. The cost of gasoline as quoted on Platts constitutes about 70% of the total build-up for refined petroleum products. So if he's interested, if I don't know who he is, but if NESG is interested, we will be willing to give you this report anyway. So let me answer your questions. The first questions, you have raised quite a number of people thought there are payoffs on the subsidy. I've argued, perhaps maybe I'm not clear enough. I've argued that we do not need to import petroleum products. That if we refine petroleum products at home, we are leveraging our potential for substantive development. Perhaps I should add that in crude oil, every barrel of crude oil contains 1,500 byproducts. We import only 6 of them. The rest is lost to our economy. Plastic industry in Nigeria, we don't get feedstock from the petroleum industry. Well, the phone we hold, there's byproduct of crude oil in the telephone, in our computers. There's byproduct of crude oil that can be used for the treatment of cancer. We lost all of that. We're saying that is the theory about subsidy. It's not sustainable in logic. It's not sustainable by data. You can't even defend them. It's shameful, if you don't mind my language. Now you are talking about trade-off. I've just told you where the subsidy is. That where the subsidy is cannot cost 3 trillion naira. Those taxes that NNPC, NPA, NIMASA, NMDPRA, and all of that are collecting cannot be subsidy. So when they talk about subsidy, we need to clarify these contentious issues. That's where we stand. However, you talk about exemption from the minimum wage. You don't really expect somebody who earns 30,000 naira to pay tax. From where? How much are you going to collect? And then you talk about VAT exemptions. And well, okay, there are goods that cover the broad. There are many goods that cover the broadest spectrum of the Nigerian consuming public. However, there's an issue you have raised. It is political. NSC stays away from politics. We try as much as we want to get involved in partisan politics. NNPC cannot withhold remittance to the federation account, but that is not our business. We don't want to get involved in it. We know what is wrong there, but we don't want to get involved in it because it's pure politics. The one that is of importance to us is the payment of minimum wage. Minimum wages are not being paid by states, some state government, not all of them, some state governments. It is not because they don't get enough allocation for the federation account. The internally generated revenue, the internally generated resources of each state can pay salaries in those states. I can tell you, we did a study on that. In Kaduna, for example, Kaduna pays 34 billion naira per annum on minimum wage and welfare issues, but it generates 56 billion internally. So it doesn't need federation account to pay. You can do the same thing for Edo, you can do for Lagos, you can do for Port Harcourt, and River State, and so on and so forth. The critical issue about our country is for whom do we govern? From whom do we derive authority, our sovereignty? Who are the sovereigns of Nigeria? Our people in government do not consider the Nigerian people as the sovereigns. They believe that they are bosses of the Nigerian people. They don't need authority of the Nigerian people. And that is terrible. That is quite terrible. So I would tell you this because you are doing a post facto analysis. I will tell you this with some degree of authority, that if there were a broader platform to discuss government policies, economic policies inclusive, this current NSC is not a previous one. This current NSC is so consensual. It's not combative. It's not quarreling with government. It wants to discuss, negotiate it, and get some results and all of that. The previous NSC, you know, the 1978, 1992 NSC that you know, was combative. So government is not willing to discuss with people. Government is not reaching out. Government has become so locked up in a cocoon that it doesn't take in its partners. I'm telling you for free that Labour used to participate in the economic team when Umaru Yar'Adua was president. After that, some powerful people shut out Labour and all of that. So some of those conflicts you see could have been avoided. But I want to repeat, and that is important, sir, that so long as we import petroleum products, subsidy will not go away. The discussion about subsidy will not go away. We can, because for the last 30 years we'll be done. Next year is election. This government will not have the courage, so to say, remove subsidy. But 2024, we'll be talking about subsidy again. So let's deal with this problem once and for all. Let's develop our economy. Let's give capacity to our people. As a matter of fact, the Nigerians who know how to refine products, Okumare refinery, many of them are retired. You can't find them now. So to pass that knowledge down is getting more and more difficult. We are losing that social capital that we had accumulated over time. So we said privatize the refinery. Get the IOC. Total, that is importing petroleum products in Nigeria. Total has a refinery in Belgium. They have a refinery in Gabon. So why can't Total run a refinery in Nigeria? The first Port Harcourt refinery was owned by Shell. Shell built it. So why can't Shell run that refinery? There's Ajib has a refinery in the Netherlands. Why can't it in Italy? Why can't it refine products in Nigeria? Why do we have to export our resources that could grow and develop our economy? Give us a petrochemical base to industrialize. How are we going to industrialize this country? If we export groundnut, we export cocoa, we export crude oil. How in the world are we going to industrialize our country? Labor shares a commonality of purpose with the private sector in some of these areas, and I will explain to you. We know that some of these policies that exact negative impacts on the private sector will cost us retention of jobs. We know that when the private sector, the manufacturing sector, the organized private sector, including the beverages and tobacco sector, we know when you impose punitive taxes on them, they will not be able to generate employment. And we don't expect government to generate employment in the economy. We don't know how many people government can employ as bureaucrats. So we have a commonality of interest with them that this sector should be sustained. We should defend them if it's necessary. That's what is done elsewhere. We run to Korea, we run to, oh, by the way, South Korea, the South Korea economy was built on petrochemical and steel. We have opportunities, we just retire them away. Our argument is patriotic. It's not about whether you will pay workers or not. We know you can pay workers if you want to. If you don't want to, we know you don't want to, not because you don't have the resources to do so. I hope I answered your question.
Yes, so thank you very much. We love the passion. And I think, align with most of what you said, particularly about can we allow, the private sector to drive how we're able to refine locally. And I do think, those multinational companies that you mentioned might be more willing to invest in building refineries if they know that it will be based on market forces to drive the price, so they can be sure that they can recover their cost and make some moderate profit. The reality is that all the countries that refine petroleum products locally are able to create more employment and add value to the economy. So that's fact, that's correct. But the reality also is that even for those who are refining locally, they have to deal with rising cost of crude oil, which then impacts on the price of those products at the pump. No matter how
we reserve we reserve 445,000 barrels of crude oil per day for domestic refining. So even if they are going to buy, we can negotiate that it should be paid for in naira. Here, you take the crude from here, refine it here. You don't pay transport costs, you don't pay insurance costs, you don't pay freight charges, you are not going to hire a vessel. 445,000 barrels of crude oil per day is reserved, is produced daily in Nigeria for refining. And you know how we got to 445,000? That is the total installed capacity of the foreign refineries in Nigeria. That's how we got 445,000. It's not an arbitrary figure. So where is the problem? When people say it's not rocket science.
Yeah, Doctor, I understand you, so we can save time, because at the end of the day, unless we're able to gain investment to ramp up production significantly, it would also mean that the 445,000 is an opportunity cost of what we could earn by exporting the crude, or actually refining it and then exporting the refined product. I'm sure that if Labour can maybe even come up with some modeling of how some of these ideas will play out and the impact on government revenue as well as the impact on the economy, I'm confident that the policymakers will be willing and open to those conversations. And NESG, we also don't do politics, like you said, but we're always willing to support policies that will promote economic development. So thank you very much for your comments. I'll quickly go to Mr. Popola. I hope you can hear me. And the question I have is, you've mentioned some of the policies that have had positive impacts on the capital market, and a few that maybe not so positive impact on the capital market. Overall, if you put all of this together, what would you like government to do differently? And how are you going to be able to work with government? Because what you do and the capital market is actually at the center of development. With the national development plan of the federal government for the federation, we see a lot of expectation in terms of the capital market and the private sector being able to finance development. How can we make all of this possible?
Okay, thank you very much, Mr. Oyedele. And I think the simple answer to that is I'll just perhaps ask that the government builds on what it already does as far as just engagements with the capital market. Of course, as you'll be aware, we do have an apex regulator of the capital markets who has historically taken a very strong lead and has a presence at many of these discussions. But I think that in that line, there could be maybe a deepening of that, because two things then I think can be achieved as a result. Number one, I think the government then will be able to rely on resource that exists within the private sector. If you think about our apex regulator, they also are sort of a government agency. On the private side of the divide, if this collaboration can be deepened, is a lot of resource that is available, whether it's for research and for development, just to make sure that there's a very holistic thought process to some of these policy. And indeed, maybe any particular, call it more operational issues like we identified when I spoke earlier could be addressed and brought very quickly to the attention of government. I think the other thing, of course, is just in the spirit of just collaboration. The industry also could be served by way of this way of engagement, such that we're seen together as partners. As I said earlier, the goals of the government is very clear. It's very laudable. Ultimately, if those goals are achieved, it has a wider impact on the entire economy and the capital market. So we are both aligned from that lens. I think that if we're able to have stronger voices, if I could say, around this, you might find that partnership is better deepened as a result of that. But overall, I think I would say that the government does listen. Some of the points that I had raised earlier when I spoke, many of these, the government is listening already, the channeling through. I spoke, for example, how we've seen, for example, in the REITs, Real Estate Investment Trust, we have seen successful in 2019, 2020, and 2021, a listening ear from government that addresses many of these things. I think that we could perhaps shorten those sorts of cycles if this collaboration and engagement is further deepened. Thank you.
Thank you. Thank you very much. I think that's entirely spot on, 100%. So let's build on what we've done that is working, and then let's engage more to see what we can do even better. So we can multiply the impact positively that we're making and reduce those unintended consequences, especially if we leverage on the resources that we have that are available and using data. I'm sure that the capital market will be more than willing to provide data, so that even for some of these policies, we can simulate what it means and how much are we going to generate within context. Is it worthwhile for any negative impact that we may see? Should the timing be different? Should we face it? And so on and so forth. And one thing I also, personally would like us to do differently in Nigeria generally with respect to policy, just to give more, I'll say advanced notices. So we've seen, different countries from the UK to the UAE, even announcing beginning of the year, saying that certain policies will kick in by middle of 2023. So you really have like 1.5 years to plan. But when we introduce policies and they take effect immediately, it's difficult, even when they're positive. So I believe that those points have been noted, and we're also noting these points to share with the policymakers officially after today's session. So lastly, I would ask Mr. Alfred Olajide. So in terms of, if you think about it, really, government has a legitimate need to raise revenue. And I don't know of anybody who is excited to pay taxes anywhere in the world. Maybe not as painful as it is in some countries like Nigeria, but then it's still difficult to pay taxes. And government, needs to raise revenue is legitimate. And at the same time, government also has, the point around we need to control consumption of sugar because of, health issues, particularly with COVID and everything being diverted away to COVID. We're having issues in the other areas. So I think the question I have for you is, how do you react to all of this? Is there a balance that government can strike, and how?
Yeah, thanks a lot, Taiwo. Look, one of the strong points that the government put on the table for this, as we had the discussions a couple of months back, to your point, is on health grounds. But if you look at what is coming out, it looks more like a revenue generation drive than the health itself, because you find things like sparkling water, for example, zero sugar containing beverages, for example, all being within the tax pocket. But I'll address I think that your question has two components. There's the tax generation component and then the health grounds component. I'll address them separately. I mean, if you look at the growth, the recovery algorithm for the country, yes, positive, GDP is improving, but you would also agree with me that it's not inclusive in its entirety. I mean, we still have the high levels of unemployment, we have high poverty rates, low disposable income, shrinking disposable income and all. So there is a need to continue to expand growth, in an inclusive way. So as a starting point, responding directly to your question, the industry is not against paying taxes, right? But I think what the industry is saying is that we don't want to pay counterproductive taxes that stifle growth. Because it's when they grow that true value is created to all the conversations we've been having. That's when they employ more people, that's when they're able to perform more CSR. Of course, you agree with me that there is a lot of work to be done in the socioeconomic space, but a company that is losing money and keeps paying more taxes would have less flexibility to do things like that the country needs. And of course, Nigeria looks more attractive to more investors and they will keep coming in. So essentially, they want to partner with the government to grow together, employ more people, empower more people, and have more Nigerians being able to feed themselves because they are gainfully employed in sectors that are driving growth. That is the true growth. Just to kind of give some context as well, I mean, the food and beverage sector contributed more than 200 billion in VAT in last 5 years. Same period, more than almost 100 billion in corporate income taxes, more than 100 billion paid in import duties in the last 3 years. So in essence, industry pays tax and they are willing to keep paying tax while they continue to grapple with this whole point around exponential increase in costs and their limited ability to pass it to the consumer who is also under pressure. As clear examples, this year alone, on an average, sugar cost has gone up northward of 20%. Plastic resins have more than doubled in terms of the prices. Aluminum bodies, can bodies are almost 100%, right? And this is in addition to all the other challenges of poor infrastructure, supply chain disruptions from security and logistics amongst that. Of course, we know recently, a couple of days ago, AGO prices have also moved up. These have direct impact on logistics and cost of operation. So especially on the need to generate more taxes side, I think we flogged it. This point also just allude that there is an algorithm for generating taxes, but that algorithm has to come from industrial sectoral growth, not continuing to, because the industry is willing to pay and they're willing to pay as they grow so that then they can grow in an inclusive way. So that rests that. On your second point, the strong argument for excise tax introduction has been on the health grounds, and it's important to actually interrogate based on evidence whether indeed this country has excess sugar consumption problem. Because according to World Health Organization benchmarks, not only are we below the threshold, we are way far below countries who have attempted to introduce sugar taxes. I think the per capita consumption for Nigeria is about 8 grams. You have in excess of 40 in many countries that do say and that they have sugar consumption issue. And then even if we assume, without considering that there is a sugar problem, which the evidence doesn't point to, the question is, why are the taxes applied in a discriminating manner? So you focus on soft drinks and include things like sparkling water. And then we're excluding other sugar containing consumables, food, and even sugar in itself directly. So that's one, just to point out that we need to question whether we're actually addressing the issue and whether the issue is actually fact-based from a health perspective. We know, I mean, from what we've seen across the globe, that taxation is not a cost-effective instrument in battling against non-communicable diseases. In actual fact, non-pricing interventions such as portion control, reformulation, lowering sugar content and all, is more effective. And this is true for many of the markets that have gone this journey, who ended up not achieving their objectives at the end of the day. So what does this mean? It means from the health perspective, industry self-regulation and collaboration with the government remains the most effective way to address the concerns around sugar consumption, if indeed we have, which again, the data is showing differently. Today, many manufacturers already have low sugar, zero sugar variants with a wide beverage options that the consumers enjoy. And they are responsible enough to lead the charge with working with the government in implementing, making this more aggressive, implementing reformulation, portion control, and all the other initiatives that address this concern around sugar in a sustainable way, as against introduction of excise tax at the expense of driving inclusive growth and economic development. Again, these guys, the industry shrinks, employs less people. I mean, the implication is far-reaching. I think luckily we understand that in the current provision, in the current act, there is an opportunity for government to choose an appropriate implementation date. And the industries ask, and I think it's similar to the previous speaker's comment in terms of the timing of making some of this legislation effective, is that we have an indefinite moratorium period, right, to allow for constructive dialogue between the industry and the government. First, on the shape and form of administering this tax. Second, on now the partnership to solve the sugar problem, if there is one, okay, so that the industry doesn't shrink further, and all the previous engagements we've tried to put on the table hasn't yielded a win-win outcome, as we currently see. So, I mean, what we have today as an outcome with the law is one-sided, government gets more revenue, industry collapses. So the industry requires this. So the industry requires this moratorium period, you know, to allow for this engagement to happen. So that, for me, would be a way to foster forward. And I'm also appealing to the Honorable Minister, because her office plays a big role in orchestrating the way forward, that the industry is actually looking for her support in creating this appropriate forum for this discussion to happen, right? And in the last couple of months, the industry has been keen, willing to meet with the minister to have this conversation and then leverage on that partnership to drive forward. And I'm sure the industry is available, even at short notice, to have this discussion with her and other stakeholders so that we can move forward. So I think, for me, in summary, just to close on that, is I think we need a period of moratorium to have a right level of engagement on the shape and form so that we can drive collective wealth creation. And then secondly, we actually need partnership with the Ministry of Budget and Finance, and specifically with the Honorable Minister, to help us orchestrate this. We are willing to meet with her at the shortest possible notice, and we will be willing to provide the support and partnership that the sector and the government requires in these areas. So that will be it from me.
Very well said. Very well said.
Can I say something?
Yes, please go ahead.
Yes, can I, please? I just want to amplify a few points that Mr. Olajide had made. The data we have is that the food and beverage industry in Nigeria has 38% of the entire manufacturing output. Mr. Olajide has also stated that they pay over 200 billion in VAT and close to 100 billion in and all that and all that. But I also want to say, this is important to us. 1.5 million workers are employed in the food and beverage industry. In other words, if, for the purpose of this discussion, the food and beverage industry shrinks, workers will lose their jobs. I want that clearly understood. Now, we have done some figures. We got some figures from Manufacturing Association, from the NECA and all of that, that suggests that with the new excise rate duty that is imposed, the 10 naira per liter imposed on sweetened beverage drinks. 40% of the current sales volume, or amounting to 1.9 trillion naira, will be lost in the food and beverage industry. We also have data that suggests that now you are talking of impact assessment, cost and benefit analysis. From this tax, this duty, government is likely to realize 81 billion naira. But government will lose 197 billion naira in VAT, company income tax, tertiary education tax, and so on and so forth. So if the manufacturers of the sweetened beverage are complaining, we should understand that this is existential for economic growth and development of our country. But this is the one I want to add. I'm shooting from the hips now. You know, our people in government and the Nigerian elite generally seem to be too disconnected from the way the ordinary person lives. I can tell you, if you go to the Federal Secretariat now, you go to any government ministry or some private sector ministries, workers will drink a bottle of soft drink and maybe a loaf of bread or biscuits as their lunch. That's all they have for the day. So if you make it impossible for them to buy, please let me tell you the consequences of that. One consequence, of course, the economic issues we are discussing. You will have an unproductive labor force. Government needs to engage more. And we have said that over and over again, government needs to consult more. These policies, some of you who are in the tax sector, who are into tax consultancy, they may be listening to you, but they also need to listen to a broader public of the Nigerian people before you carry out some of these policies. Thank you so much, sir.
Yeah, thank you very much for that. You know, just approach is to collaborate with the industry players and think about what else we can do to accomplish that without any negative impact. And I'm sure that the Honorable Minister is always willing to engage. So I'm sure these requests and comments are well noted. We have only just 3 minutes left. So in the Q&A room, we have a request for the table by Dr. Onoho, and then I don't know whether that will be provided, but if we have the approval, NESG might be able to share with those who participated at this event.
Those data are from the Nigerian Petroleum Company, NNPC. You can share them. I have no problem with that.
Okay.
I indicated the source here.
Okay, thank you for confirming that. Someone says that government needs to sanction the MDAs who refuse to remit their surplus funds. We agree, and I think government is already taking steps in that direction. Someone said on treasury bills, government wants to go back 10 years on withholding tax. I don't think that is true. Maybe going forward is what you probably have in mind. We need to nudge strategies government will develop to achieve so I think you're saying government needs to think about how do you accomplish the goals of the Finance Act 2021 while limiting the impact in the negative manner on the economy. And then given Nigeria's business environment, are industry willing to pay or be compelled to pay because they have no choice? And also you raised a point around SMEs, as well as behavioral issues, incentive. Okay, I think this is general comments, and that's from Badebo Odulari. So thank you very much, everyone, for your comments, for your questions, for your interventions. We really appreciate our panelists and our speakers. And I'd like to apologize on behalf of the Honorable Minister. I understand the Minister logged in but had issues being able to speak, and that we couldn't sort out, and she had to eventually leave. But we promise that all the key points will be communicated appropriately. And we know from our experience with the government and also with the Ministry of Finance in particular, the Act on this input to the extent that they are objective and they're supported by data, because at the end of the day, it is not government versus the people. It is government and the people working together for the interest of the country. On this note, I'd like to thank everyone once again. I'd like to thank the NESG team for organizing all of this. I'd like to appreciate our participants, as well as our general audience for your attention today. This is the end of the session. We have come to the end of the webinar, but let's keep the conversation going online. You can follow NESG on various platforms as well as on YouTube. I believe that this event was recorded live on YouTube, so which means you can play it back. Do enjoy the rest of the day and do have a great time ahead. Thank you very much and bye for now.